Listen up, because we're diving into the world of IPOs and private equity. Two very different paths companies take to raise big bucks. Think of it like this. An IPO is like throwing a massive party on Wall Street. You're inviting anyone and everyone to buy a small piece of your company. We're talking shares of stock. It's a public affair, and everyone knows about it. Private equity, on the other hand, is more like a closed-door meeting with a select group of wealthy investors. These firms, often with deep pockets, take a big stake in your company behind closed doors, away from the prying eyes of the stock market. So, which path is right for your company? Well, buckle up, because we're breaking it all down. Let's talk about the moolah. IPOs are like giant money magnets. When you go public, you're essentially selling off pieces of your company in the form of stock. This influx of cash can be massive, giving you the firepower to expand your business, pay off debts, or even buy out competitors. But remember, going public means sharing the wealth, literally. Your profits are now divided amongst all those shareholders. Private equity, on the other hand, is a more exclusive club. These firms inject large sums of capital into your company in exchange for, you guessed it, a big chunk of ownership. Unlike an IPO, the money isn't coming from the general public, but rather from a select group of deep-pocketed investors. Think of it as a financial partnership with some very savvy and demanding investors. Here's the deal. When you go public, you're essentially giving up a piece of your company to anyone who buys your stock. You're accountable to these shareholders, and their opinions matter, especially when it comes to your company's performance. Think of it like having thousands of new bosses, all with a vested interest in seeing your company succeed and their investments grow. Private equity is different. Instead of answering to thousands of shareholders, you'll have a smaller group of private equity partners calling the shots. These partners typically have a lot of experience in your industry and can offer valuable guidance and support. However, be prepared to make some tough decisions together. After all, they have a big stake in your company's success. Section 4. Jumping through hoops, regulations, and rules. Going public is no walk in the park, folks. It's a long and arduous process filled with regulatory hurdles and mountains of paperwork. You'll need to file with the Securities and Exchange Commission, and trust me, they don't mess around. Get ready to open your books, disclose your financials, and answer to regulators. Transparency is key here. Private equity, while still subject to regulations, offers a bit more privacy. You won't have the constant scrutiny of the public market, and your financial information won't be splashed across the Wall Street Journal every quarter. That being said, you'll still need to answer to your private equity partners, who will want to keep a close eye on their investment. Section 5. Cashing in, timelines and exits. So, you've raised a ton of money, congrats. But how and when do you cash in? With an IPO, it's all about that exit strategy. Early investors and employees can sell their shares on the public market, hopefully for a tidy profit. Of course, the stock market is a fickle beast, and there's no guarantee of a big payday. Private equity, on the other hand, usually involves a longer-term commitment. These firms typically look to exit their investment within 3 to 5 years, either through a sale to another company or by taking the company public themselves. Talk about coming full circle.